Okay, I have to start with a number that it just stopped me in my tracks. 43%.
It's a massive move.
I mean, it's startling. That is how much 3M's stock price surged in just the 3 months leading up to the earnings report we're looking at today.
And you have to put that in perspective. You usually see that kind of volatility in, I don't know, a biotech startup or a crypto token.
Exactly.
You do not expect it from a century-old industrial giant that, people usually buy just to park their cash for a safe dividend.
That's the whole perception, right?
Yep.
3M is supposed to be this boring, steady ship, but clearly something dramatic has shifted under the hood. So welcome to the deep dive.
It is a fascinating time to be looking at them.
It is. Today is January 21st, 2026, and we're unpacking 3M's Q4 and full year 2025 earnings, which dropped yesterday.
And if you look at the backdrop they're operating in, they use the word muted. U.S. industrial production is basically flat. The macro environment is not giving them any kind of tailwind.
And yet, the stock is just ripping higher. So our mission today is to figure out how. How are they pulling this off? We've got the earnings call transcript with the CEO, Bill Brown, and CFO, Anurag Maheshwari. We have the press release, the slides,
Right.
and we're going to unpack this mantra they keep repeating, controlling the controllables.
It sounds a bit like a football coach in a post-game interview, doesn't it?
Really does. We just got to go out there and execute. But here, it seems to signal a very specific corporate strategy. They keep talking about this transition from a holding company to an integrated operating company.
And that distinction is the absolute core of the story here. It's the difference between just owning a bunch of businesses and actually running them as one cohesive unit.
Okay, we will definitely get into that.
Yeah.
But let's start with the scorecard. The numbers they released yesterday. What's the headline?
Well, the headline is, "It's a beat," as they say on Wall Street. They reported adjusted earnings per share, EPS, of $1.83 for Q4.
And the estimate was?
The consensus was $1.80. So they cleared the bar by 3 cents.
Okay. And the top line. How was revenue?
Revenue came in at $6 billion. Now, strictly speaking, that was a slight miss against expectations, about 26 million light.
A miss.
But, and this is the crucial part, they still showed positive organic growth of about 2.2% in the quarter.
So they sold a little less than the experts guessed, but the market didn't seem to care. I mean, the stock closed around $155. Why the optimism if revenue was just okay for
You have to look at the trajectory. The last 3 years really tell the story. In 2023, 3M was shrinking. Organic growth was negative.
Right.
In 2024, they managed to claw back to, 1.2% growth? And now for the full year, 2025, they've accelerated to 2.1%.
So they stopped the bleeding.
He stopped the bleeding and they started walking forward. But here's the number that explains the stock price. Sales only grew by low single digits, that 2% range. But their adjusted earnings per share for the year grew 10% to $8.06.
That is a huge gap. Sales up 2%, profit up 10%.
That gap is pure efficiency. Their full-year adjusted operating margin hit 23.4%. That is up 200 basis points year over year.
In plain English, that just means they're getting way better at turning a dollar of sales into actual profit.
Drastically more efficient.
So this efficiency thing, it's a corporate buzzword that usually means layoffs.
Yeah.
But CEO Bill Brown keeps using this other phrase, back to basics. What does that actually look like inside a 3M factory?
It's the unglamorous, gritty work of manufacturing. He breaks it down to 3 pillars: commercial excellence, innovation, and operational excellence. And that last one, operational excellence, is where the magic is happening on the margins.
The grunt work.
The plumbing. They are obsessed with a metric called OTIF.
OTIF. On time in full.
It's exactly what it sounds like. When a customer orders a pallet of adhesives, do they get exactly what they ask for, and does it arrive on the day you promised?
I mean, that feels like table stakes for running a business. If I order a pizza and it's 3 hours late with 2 slices missing, I'm not exactly thrilled.
You're not. But in these complex industrial supply chains with thousands and thousands of products, hitting that target is incredibly hard. 3M's OTIF is now consistently above 90%.
And he said that's the best it's been in decades.
Decades, yes.
Wow. But help me connect the dots. Why does hitting 90% OTIF make the stock go up? Is it just about making customers happy?
It is about money. If you're reliable, you win shelf space. If you're a distributor like a Grainger or a Fastenal, you want to stock the product that you know is going to show up.
Of course.
It just reduces customer churn. Fewer people leave you for a competitor because they're frustrated.
So reliability protects the revenue.
It defends the top line. And then there's the other side of it, the cost of poor quality.
That sounds like a painful line item on a spreadsheet.
It's basically all the money lost when you make defective stuff, scrap, yield loss, things you have to throw away. They drove this down to 6% of goods sold, which is a 100 basis point improvement.
So that's literally money that was going into the trash bin that is now going to the bottom line.
Exactly. They're using visual inspection systems, AI in the factories to catch defects earlier. Their target is to get this below 4%, so there's still more to go.
And there was another acronym in there, OEE, Overall Equipment Effectiveness.
Right. Asset utilization. It's up to about 63%, up 300 basis points.
Practically, what's that mean?
It means their machines are running more and sitting idle less. If you've got a billion-dollar factory, you want those machines humming 24/7. Idleness is just incredibly expensive.
So back to basics isn't a slogan. It's fixing the plumbing, making sure the machines run, the products work, and the trucks leave on time.
It is boring, but it is incredibly profitable. And then you pair that with the second pillar, commercial excellence, tighter pricing controls.
So fewer discounts.
Smarter discounts, making sure that if they give a discount, they actually get a volume commitment in return. They also closed nearly $50 million in cross-selling wins.
Cross-selling, that's the whole, you bought the industrial glue, you must need the safety goggles and abrasive pads too.
That's the logic. And for a company with 3M's massive portfolio, that opportunity is huge. They have tens of thousands of products.
Okay, so the plumbing is being fixed. But 3M is famous for invention, Post-it notes, N95 masks. I feel like for a while the narrative was that their innovation engine had kind of stalled out. Are they actually inventing things again?
The data suggests they're reigniting that engine. This is the third pillar, innovation. In 2025, they launched 284 new products.
Is that a lot for them?
It's up 68% from the year before. And for 2026, they're targeting 350.
That's a serious ramp up.
Yeah.
But are people buying the new stuff? Or are they just launching things for the sake of it?
It's a good question. They track it with something called the Vitality Index, or NPVI. It measures what percentage of sales comes from new products. Right now, it's at 13%.
That seems pretty healthy. It's not just the same old Scotch tape from 1990.
Correct. But here's where it gets really interesting, and I want to get your take on this. There's strategy in electronics.
Yes, I saw this in the transcript. They're talking about entering the mainstream market.
Right. Traditionally, 3M plays in the premium space, high-margin, niche products. But Bill Brown talked about a shift. They are now designing products designed to cost to compete in the mass market.
Designed to cost. That sounds like code for cheaper.
It means you start with the price the market will pay, say, for a film component in a mid-range smartphone in China, and then you engineer the product to be profitable at that price.
That's a huge shift. I mean, usually 3M makes the best thing and says, here's the price, take it or leave it. Now they're reverse engineering to a budget.
They're going after foldable devices, data centers, specifically targeting China and Asia. They are lowering their own cost structure to attack high-volume markets they used to ignore.
But doesn't that feel risky? If you start playing the low-cost game, you risk eroding your premium brand and your margins. You're fighting in the mud.
That is the big question. Management claims they can do it because they're stripping cost out of the manufacturing process first, but it's a fundamental identity shift for them.
Okay, we'll have to watch that one. Let's pivot to the winners and losers inside the company. Not every department is doing great. Who gets the gold medal this quarter?
The gold medal goes to SIB.
Safety and Industrial Business Group.
Yep. They were up 3.8% organically in Q4. This is the heavy industry stuff, electrical markets, and aerospace especially.
Aerospace makes sense. The demand for new planes is just off the charts.
It is, and 3M has strong pricing power there. If you need a specific adhesive for an airplane wing, you don't shop around, you pay for the 3M spec.
True. Who's in the middle of the pack?
That would be TBG Transportation and Electronics, up about 2.4%. This one is a tug of war. Aerospace and electronics are doing great, but the transportation part, specifically automotive, is weak.
Fewer cars being built.
Fewer cars, and especially weakness in commercial vehicles, but luckily the electronics demand is offsetting that.
Okay, so that leaves the problem child. Consumer.
The Consumer Business Group, CBG, down 2.2% in the fourth quarter.
Ouch. This is the stuff we all see at Target and Home Depot. Post-its, command strips. Why is this tanking?
It's discretionary spending. The report was pretty clear. People just aren't buying office supplies or home improvement items like they used to. The macroeconomy is hitting the average shopper.
I saw something weird about December. Didn't they have a big spike?
Yes, and this is a crucial nuance. October and November were weak, but December was actually up double digits.
So everyone bought Post-its for Christmas.
Well, 3M ran some heavy promotions. They discounted to move product. So while volume went up, it suggests they had to, buy that growth a little bit. And it still wasn't enough to save the quarter.
And inventory's still high in those channels.
A bit elevated, yes.
Right.
Unlike the industrial side, which is normalized. So consumer is definitely the drag on the ship right now.
Okay, looking ahead to 2026, what's the guidance? What's the crystal ball saying?
They're optimistic, but cautious. They are guiding for full-year organic sales growth of about 3%.
So an acceleration from the 2% we just saw.
Exactly. And they expect EPS to land somewhere between $8.50 and $8.70.
And they're putting their money where their mouth is. I saw a number for buybacks.
A big one. $2.5 billion in share buybacks planned. That's a strong signal of confidence.
But there are always headwinds. What are the watch items? What should we be worried about?
Two big words, tariffs and PFAS.
Let's start with tariffs. Always a hot topic.
It is. So there's already a carryover impact from existing tariffs. But the news about potential new tariffs on Europe and, interestingly, Greenland came up on the call.
That's specific.
Yeah. But management estimates a 10 to 25% tariff on European trade could hit them for $30 to $70 million. And that is not currently in their guidance. It's a risk.
A risk hovering over the forecast.
Okay.
And PFAS, the forever chemicals that have been a huge legal issue.
Right. The legal part is mostly behind them, but the operational exit is expensive. They call them stranded costs.
What does stranded cost actually mean?
Think of it this way. You rent a huge factory to make a chemical. You stop making the chemical. But you still have the lease on the factory, the security guards, the light bill. You have all the costs, but zero revenue to pay for them.
So it's just dead weight on the P&L.
Exactly.
Yeah.
And that dead weight is rising to $150 million this year. It's just a drag on margins they have to eat.
They're also spending money to make money, though, right? There were some investments.
$225 million in incremental spending, mostly on growth and productivity, which includes restructuring their factory footprint.
Which leads us to the final big theme, transformation. Bill Brown talked about moving from foundational to transformational. What does that mean for the company's structure?
This is the really long-term play. Think about 3M's history. It grew by acquisition. It was this massive collection of businesses.
A holding company.
Right. A loose collection that just happened to share a logo. Brown wants to turn it into an integrated operating company. Standardized processes, shared supply chains. Instead of 50 different divisions doing their own shipping, you have one massive logistics machine.
And footprint optimization.
That is corporate speak for closing factories. They have about 100 factories right now. They're looking to consolidate that network pretty significantly to improve margins.
And of course, they threw in the buzzword of the decade, AI.
Of course. But in manufacturing, it's actually real. An AI-first mentality means using machine learning to predict when a machine will break before it breaks, or tweaking a production line in real time to save 1% on raw materials.
And when you operate at 3M scale, those little percentages add up to hundreds of millions of dollars.
Precisely. It's not hype, it's yield.
So to wrap this up, 3M spent 2025 stopping the bleeding. They fixed the plumbing, OTIF is up, waste is down, and now they're trying to pivot to real growth in a flat economy.
That's the summary. They're growing earnings double digits in a sluggish world because they're fixing their own house. It's a classic operational turnaround story.
So why should the listener care unless they own the stock?
Because 3M is a proxy for the entire industrial economy. If they can figure out how to squeeze growth out of a flat market through efficiency and this design-to-cost philosophy, you can bet every other manufacturer is going to try to follow them. It proves execution can matter more than the macro.
It's the controllables lesson. You can't control GDP, but you can control if your trucks leave on time.
That's the takeaway.
All right, here's my final thought to leave you with. We talked about that shift to design-to-cost in electronics, going after the mass market. 3M has spent a century being the premium option, the Mercedes of industry. If they start competing on price and volume, do they lose their soul?
That is the multi-billion-dollar question, isn't it? Can you be the premium innovator and the mass market supplier at the same time?
Yeah.
Or does chasing volume eventually dilute the very brand that lets you charge those high prices in the first place?
It feels like a dangerous tightrope. Can they maintain those famous 23% margins while fighting for market share? I guess we'll find out in 2026. Keep an eye on that new product vitality index. I think that's going to be the real scorecard.
I will be watching it very closely.
Thanks for listening to The Deep Dive. We'll catch you on the next one.